Most people kind of don't take responsibility with their finances. They hand the money over, hope for the best, and when it doesn't work out, they have someone else to blame. Financial freedom isn't what most people think it is. You can't have financial freedom by money in a bank account. It's a state of mind. It's a perspective.
Why do you think it is so challenging for people to truly change their thinking pattern around money?
Money follows value, not effort. That's why people are upset, is because money doesn't play the rules of effort and time. Money plays the rule of value, and that's all money gives a shit about.
Welcome everybody back to the Average Sucks Show. Super excited about this episode for a couple of reasons. Last time I had this guest on, the amount of emails and comments and DMs that I got about this episode that we did was absolutely amazing. He reached out to me recently, told me about a new book that he's got out there, which is absolutely incredible, and a topic we started talking about the phone. I said, hey, listen, why don't we just come right back on the show and we're going to make this even better than last time. So Garrett Gunderson, who you're about to meet, you can find him at GarrettGunderson.com. If you're not familiar with Garrett, he is literally, the best way I can explain it, financial wizard, guru, understands money, understands the money system, how you could dominate as an entrepreneur and not just make money, how to actually make your money work for you instead of against you. And most importantly, really how to learn how to respect your money and really make it grow into what you want it to be. So also a comedian, which is really a fun part. We talked about that in the last episode that you ought to watch. An incredible dad, a father, a husband, and most importantly, an incredible friend. Somebody, a friend of mine, but also somebody could be a friend of helping you grow your business in your life. So Garrett, we are back again. You like that intro?
Bro? That's a great intro.
I saw,
I'm just going to
I saw your eyes. Yeah. You're like, I'm going to remember that one.
It's good. You articulate it well. You know, I couldn't say it so succinctly and powerfully. It's like make, grow, keep, multiply. Like you had it all.
Yeah, make, grow, keep, multiply. So money unmasked. I love it. Like, explain this to me. People launder money. They clean money. They unmask it. What do they rip off the face of money? Money unmasked.
Well, people are confused about what money is. And so like what I'm saying is it's like blinding them. They think that the pursuit of money is the ultimate goal, but it's actually the byproduct of value creation. And so when we start to understand our own value, grow that value, and you get like most people, instead of growing their value, try to grow their money in things they don't know or understand. Like think about right now what's going on. Market's going nuts.
Yep.
It doesn't bother me at all.
Yes.
I have $0
well, no, why doesn't it bother
in
you?
Stocks.
Okay, because you have nothing in it. Okay, so you don't play in that
game?
game?
The stocks I care about are my businesses, and I can grow those. And in times like this, people start to listen. I don't want people to go through this turmoil, but I happen to have solutions for them because they are.
Okay, got it. So we got a bunch of people listening right now. We got everyone from corporate America. We've got people from entrepreneurs, got people in 401ks, got people in 507.6s, 4312s, everything going on.
All the numbers.
So nothing's actually wrong with anybody's doing. Is it something wrong with what they're doing, or is there different ways?
All right, so let's just break this down. The stock market came about because companies wanted to raise capital in order to build some big vision.
Okay.
And if they didn't raise that capital, they couldn't have the infrastructure they wanted.
Okay, so let's backtrack real quick.
Yeah.
A small company. Okay, not a publicly traded company.
Yeah, so this is
if
before
the company would go
public.
public. So let's say I'm like, I want to scale HCI, I want to go public. What is the real benefit of it? I know there's the IPO, but
So
let's
the
slow
early
this
days.
down.
We're
Let's
going to the
go early days.
The early
I'm
days
a little merchant. I got a horse outside. I got the Kennedy's running the stock market. Is that right? Kennedy Senior.
I need some money, and I can either borrow it, or I can give up equity.
Okay.
And that's what the stock market was. I'll give up equity, and it becomes public, so it's more liquid. And so they could raise that capital. But what it's become is a way for people to take money off the table, not necessarily for a company to be great. The company gets great early on, and then they get private capital. Private capital, for the right private capital, is double the return of public capital, like the stock market. And so now when they go, we're gonna IPO, they're just taking money off the table. They're not actually reinvesting it back in to grow this business in a massive way.
Interesting.
They're benefiting from it. So it's not what it used to be. So I don't really buy into it.
Got it. So let me make sure I understand this.
Yeah.
I got a little mercantile business. It's back in 1922. I've got like all my leather outside, a leather business, whatever it is. And I'm like, I want to grow this thing.
I want to franchise this puppy.
Franchise this puppy. You know, franchise wasn't existing until the 60s, right? So let's walk through this real quick. So if I go to you and go, hey, let's do business together. I'll give you equity in the company. Let's say I'll give you 10%
Yep.
for either money, sweat equity. You now get 10%. You're saying I could give up 30% of my company for an unlimited amount of money in the market.
Well, it's not
How does
unlimited
that?
because
How does
they
that?
only get.
I want you to teach. I want you
Yeah.
to educate me because a lot of people open up an E-Trade account. They gamble. They bet on
Yes.
things. They do what you don't teach. And I do that too a lot of times. And I consider myself pretty good at betting.
Right.
I bet on winners. And don't talk about the other ones. Right. But so let's talk about that for a second. How do I do it?
So the first thing is an initial public offering.
Yep.
So the initial public offering is the only time that the owners are actually immediately receiving money in order to get that capital. Otherwise, it moves to the secondary market. The secondary market, if they retain shares, they can sell that on the secondary market, but there's a finite number of shares at that point. They're not issuing new shares. So the secondary market is just what's the temperature of people's feelings about that company. That's why if we go back and we look at Enron, it was a very high value because there was a lot of
90s or 2000s.
It was like 90s, right? Rolling blackouts were coming from these energy brokers. It was a problem. And people are like, oh, this thing's great because it was all based upon fraud. And then as soon as the fraud was exposed, the stock went to nothing because there's no value there. It was all artificially propped up because it's the secondary market. So the initial public offering, they're saying this is what we think it's worth. And then the secondary market is all supply and demand.
It's all feelings and emotions.
It's all feelings and emotions, supply and demand. Like if you're going, no, I don't want to sell this. It's so valuable. It's going to grow. You're holding on. And people keep offering you more money to try to entice you to sell. But unfortunately, people are mindless about it now. Michael, they're just like, oh, I just put my money in every month and I'm going to wait for 30 years and hope for the best.
Interesting. So what you and I talked about prior, we were talking about winging it. And I think a lot of people, like when I talked about my daughter with figure skating, I would say, she used to think that if you show up at the competition and you're a good person, you did a good job, you may magically do well that day.
Right.
So you're saying, I'm 35 years old, I'm going to get in the market, stay till I'm 65, let's hope that year's good?
Yeah, let's just hope that all works out. And here's the thing. It's so amateur because what they're taught is, you're not smart enough, Michael, to understand the stock market. Let's give it to Wall Street and trust them. Now, first off, would you trust Wall Street with any other brand?
Probably not.
Yeah.
And I say probably because you got me thinking, makes sense, yes.
Yeah. So now we're going to just hand our money over in the companies we know nothing about, and we're going to wait for 30 years or age 65, whichever's greater, and hope for the best. Well, guess what? 95% of people that are age 65 in America are not financially independent. Here's why. We've put money into an economy or in a stock market that creates very little cash flow. And the way we become financially independent is have assets create cash flow. So it would be like saying to your daughter, honey, there's no reason to train. Just take it easy, relax, rest as much as you can so you have the best on that day. That's what we're taught with our money. Don't train for cash flow over your entire life. And now when you're retired, you have to turn that asset into cash flow that you've never trained
You've
your
never
entire
played with cash
you've
flow.
never played with. And by the way, you have these three villains that are going to enter your life at that point. Interest rate fluctuations,
Yep.
because if interest rates go down, your income goes down. Tax fluctuations, if taxes go up, your income goes down. Inflation, if there's higher than expected. I mean, the worst case scenario, let's go to 2022. So if someone retired in 2022, it couldn't have been a worse year because interest rates increase. Now, if you have a fixed portfolio of bonds, right, when interest rates go up, your bond value goes down because it's this way. If I have a $100 bond, just to be simple,
Yep.
and it's earning
You're
3%.
talking like municipal bonds?
Yeah, municipal,
Yep.
corporate,
Okay.
treasuries, any kind of bond has an
Which
inverse
seems like they have a great
relationship.
tax savings.
Yeah, it's an inverse relationship that if interest rates go up, your bond value goes down. If interest rates go down, your bond value goes up. So, for example, if I have a $100 bond at 3% and interest rates go down to 1.5%, my bond just went up in value because every new bond holder has to buy one at 1.5. I have one at 3. They're willing to pay me more because I'm earning more interest than the new bonds.
Interesting.
Now, if on the other hand, interest rates go, the opposite way, right? Interest rates go up and I'm at 3%, now they're at 6. I have to sell my bond for less because nobody wants a 3% bond if you can go buy a new one at 6. And so now someone's retired and interest rates, what do? They went up, so their bond values went down. At the same time, inflation came roaring. So inflation goes to 10%. That means that in 2023, you just took a 10% hit on what you could buy on a portfolio that just declined because you didn't understand cash flow.
Okay, so let me just preface this with the audience right now, everybody watching this, make sure we understand this. Is this financial advice or financial education?
Financial education.
Okay, and the reason I say that, explain to me the difference. I don't know if you've ever been asked that question before, but explain what I mean by advice and education.
I'm trying to have people understand how it works so they can be more informed.
Got it.
Right?
So you want people to understand how it works,
Yeah.
make a decision that they want to make based on once they know it works.
Yeah.
You're saying people are ill-advised and uneducated.
Yeah, and they're advised in a faulty framework, and this is what a
This is your
faulty
first
framework.
book.
Yeah, it is. It's exactly the first book, Killing Sacred Cows. The faulty framework is a belief that wealth is a function of 3 factors: money, times rate, times time. But how are people told to get wealth? Well, it takes money to make money. That's not true. I've watched you make money out of thin air because of relationships and ideas, value, and exchange. I've watched it.
Yeah.
We've been at the same event. And I watched it happen.
Yep.
And those people were better off.
Yep.
The second thing is they tell you high risk equals high return. And there was a bunch of journalists once that got together, and they were studying why entrepreneurs were successful. And they were going to give this report at a conference. This was a long time ago. And Peter Drucker was in the crowd of the effective executive. And they said, we figured it out. The one thing entrepreneurs do that make them wealthy that no one else does is they take risk. And Drucker got up and he goes, you're completely wrong. They take calculated moves based upon knowledge, so they're actually good at mitigating risk. It only seems risky to you because you don't understand what they're doing and how they're doing it, so it seems like magic.
Wow. Got it.
And so this wealth equals money times rate times time. The third thing is, you're in it for the long haul. Well, this is a neglect of stewardship. This is saying, hopefully it works out, but it's not working out. So I would say the difference that I would recommend is this trifecta. First off, get financially fit. What does that mean? It means making sure that you're on financial stability and everything's cohesive and working together. So whether it's car insurance, homeowners, liability, disability, medical,
what do you mean
life,
by cohesive?
So if I don't have enough money in a savings account, here's a good example. I have no money in savings. I probably have to have really low deductibles on my car insurance and my homeowner's insurance in case something happens. Low deductibles increase premiums. If you have a claim on something inconsequential, like a fender bender that's $700, they're going to raise your rates. So simply having more savings might not have a good return. Maybe it's 5%, but it might save me 20% of my insurance. Because now I move my deductibles to $1,000. I cover those small things out of my own pocket, so I don't get rates raised, and I only use it for catastrophic things like a house burning down or a major flood or something like that.
You only use the insurance for that.
You only use the insurance for that. You use your cash for fender benders, small things, because it won't raise your rates and it will lower your premiums. That's an example of having your having your financial house in order means if there's an unexpected financial surprise, you've transferred the risk. So if you're not overpaying tax, which unfortunately 93% of entrepreneurs do.
We're going to get into that later, how people can appropriately pay the right amount of tax.
Totally.
Stick with the show, guys. You're going to want to hear this.
If you have the right corporate structure, so you're paying yourself properly, so that you've eliminated a lot of that liability. If you have good cash flow reporting, which will let you get better interest rates on loans. If you have a good credit score, so you have the lowest interest rates. This is your financial house in order. And I have a checklist. Look, I'll just give the checklist.
So okay, first off, people listening right now, they're watching this, they're either in the car or they're watching this online and they're listening and they're like, okay, that sounds good. I don't say freaking them out. You're getting them excited. You're also challenging them. Yeah. Is there a way that later they can get, or you could tell them how they could get a checklist?
I'll just give them the checklist right now. They can DM me at Garrett B. Gunderson.
Yep.
And they need to put average sucks.
Average sucks.
Says
done.
Average sucks.
Okay.
We're going to give them the financial health assessment. There's 2 parts: safety and security. And don't cheat. They just need to get the sheet. Don't look at your stuff. Take 10 minutes and go, yeah, that's handled. No, that's not. Or I'm not sure. Because if it's no or not sure, then you can pull your documents and go, let me find out. Okay. Then we go money and investing. Same thing. Another 10 minutes. Yes, no, or uncertain. And it takes some courage to do this because some people like to I'll just make more money. That's the worst thing entrepreneurs do, is they think they can just make more money. But if they have leaks, that more money doesn't end up to be more wealth or even maybe more quality of life. It just evaporates.
Interesting. So let's say, okay, so I'm watching this right now. I own a gym. I have clients that own gyms. I have clients that, they're pressure washing companies. I have people that they own studios, the hair salons. They work with a hair salon, I got people that clothing manufacturers. I got a little bit of everything. Lawyers, doctors. Mom and pop, 9 or 10 people in their company. They're hearing this right now. They probably got $1 million away, $500,000 to $1 million somewhere in investments, in savings, retirement. Business is going well enough to get by. They're not stressed about anything. What are 3 or 4 quick moves they can do to get the biggest hit, like in their life? It's sort of like,
I'll give them 4.
I want to hear 4, but this is the level of hit I'm looking for. the hit somebody gets when they cut out like carbs and they immediately go, oh my God, this is great, but one that will stay.
Yep. So
because if you're addicted and you love pizza and you tell someone to stop eating carbs, they're going to look great. Go.
This is the 4 I's to efficiency.
Okay.
So look.
They all start with I?
Yeah, they all start with I.
I. Okay.
So
make it all about you.
Because the first thing is when people budget, it actually puts them in a constraint mindset, and they usually rail against it eventually, and it creates a backlash. So they're told to live within their means. That's a good way to be average because they think, I'm going to cut out expenses. There are 2 other ways to live within your means. Be more efficient with these 4 I's or expand your means.
Okay.
You teach people to expand their means all the time.
100%. Play bigger.
So I'll do the efficiency. First I is the IRS. We already talked about it. But look, most people are just tipping the government. If you get a refund from the government, you just gave them an interest-free loan. If you are paying more than like 20% tax, even if you're in a high tax bracket, you're overpaying the government. If you're a business owner, the first few pages of the tax code say why you have to pay taxes. The next several thousand are all the reasons you don't have to. And it's right there in black and white that people miss because they have historians, not strategists.
Got it.
So the second I is...
Let's focus on the IRS.
We can first on the IRS. We can go deep in here.
The IRS. So my opinion of the IRS is they're not like this evil person. I sold tax services for years when I was a kid.
Yeah.
Selling tax services. It's the funniest thing is a direct sales company where I literally trained people how to start a business to save money on taxes. It was Sandy Botkin, all these people,
Nice.
how to pay zero taxes, the guy that wrote how to pay zero taxes. And they said, you got to look at the IRS like a really nice kindergarten teacher. They mean well. They just got rules to follow. They got things they need to do. They don't really have anything out to get you. It's just if you're
not reporting your income.
Yeah, if you don't show up for school, then they're going to come to your house.
Yeah.
Right? So if we're working with them and we're like, okay, we got this thing, what are some moves or some thoughts or some ways of looking at this to get you to stop? Because I learned at 19 years old, take as many exemptions as you can.
Yep, totally.
You're better off paying them than them take an interest-free loan, interest-free or whatever it is.
We're on the same page.
Yeah, okay, got it. So there's that. In our teams, I didn't understand until later about hiring my kids.
Yep,
I didn't understand all those things that I understand now.
Yep.
And really to get them to work. What are like 2 or 3 moves with the IRS that are what would just make them not upset?
I'll give them the framework, and I'll give them 2 really clear moves. So there's 3 buckets to this: the team that you have, the deductions you take, and how you classify your income. Those are the 3 buckets. The team is you want timely data. Whether you're a small business and you have a part-time bookkeeper, or whether you're a bigger business, you have a controller or CFO, timely data is one of the biggest reasons why people overpay tax. They talk to their accounts between January and April about what happened the year before. All the tax savings comes the year before, during the year. Everything after becomes tax deferral, and that's not the same as savings.
Yes.
Savings is you don't have to pay. Deferral is you don't have to pay right now. Very different. You still have to pay it in the future. And if you hate paying taxes today, the older you get, it's not like you get more nice and go,
really like paying taxes.
Like my grandma, she got more angry as time went on. So the second thing is you want a strategist that proactively navigates this every quarter versus a historian that tells you once a year what you owe. The strategist's job is to help you to deductions. The third one is you want an attorney. If you're a business owner doing less than $1 million, this could just be a corporate attorney that sets up your corporations that classify your income. If you're over $1 million, you want a tax attorney that will really help you with probably 2/3 of your advantages.
Got it.
And then finally, if you own your own building, I know some people that
I got my own building,
then you can have an engineer do a cost segregation analysis to accelerate the depreciation so you get more deductions now versus later.
100%.
So that's the first bucket. The second bucket is you're a business owner. Every time you spend money, I want you to ask the question, could this relate to my business? If you're unsure, you put in a bucket called unsure, and when you talk to your accounting team, you say, can I write this off? If you're sure, you just document it. That's it. That helps. But here's all the deductions most people miss. The Augusta rule, 280G. You can rent out your home 14 days a year to your business, write it off as a business, and not claim it as personal income.
That's amazing.
So
I've seen that before. I didn't really think about renting out to myself.
132J.
Okay.
If you have a pool, a cold plunge, a gym, and you have employees that you allow to use it, which I have a company that's just my family. 132J allows you to write off all the maintenance of that.
Oh, wow.
Right? 199A is one of the biggest ones. That's a deduction that if you have employees that are W-2, you get a pass-through deduction called a qualified business deduction on your income. It took me from 37.5% to 29%. So those are just a few really, and home offices, I've had accountants say, oh, you can't do that. Well, before 1996, you couldn't write off a home office. You have been able to ever since. So most accountants are saying, oh, I don't want to get you audited.
What do you need for home office? Do you have an outside door, inside door?
Like my wife has an office at the house. I have an office at the house. What percentage of the square footage are those? Okay. I can then write off that percentage against utilities and all that kind of stuff. So
utilities, internet. Separate, do you do the separate internet for that, or do you
no? But I get a write-off piece of the internet.
Got it, because the percentage based on the percentage. Mm-hmm. Okay, cool, yeah.
So then the third category, this is the big category, reclassification. 4 ways to reclassify. Number 1, active to passive income. So if you were just an S corp as an example, and you took a reasonable salary, not what Michael Bernoff's worth, but what would you pay someone else to do your job?
Okay.
Then take the rest when you're a business owner as distributions. Distributions avoid self-employment tax. That's a minimum of 3.2% up to 15.3% just because you wrote 2 checks instead of 1. That's a big one. Second one, how can we go from ordinary income to capital gains? People making more than $650,000 of income are in the top tax bracket. So if you can get that to be a capital gain, like how this building is a capital gain, or if you had a bunch of international clients, we could set up an international sales company. All that money comes in capital gains to ordinary income. Those are just 2 examples, right? So the third category is tax-free. There's actually a lot of tax-free options. If you're a C corporation in a certain field of business and you own that C corporation for 5 years, when you sell, every partner can sell $10 million tax-free just by being a Section 1202. Or if you're charitable, you can donate a property like this when you sell it, not pay taxes, get a small tax deduction, and take income off of that for the rest of your life through a charitable trust. Or tax arbitrage. You had someone call you right before this, and you're like, Garrett, is there good deductions for art?
Hilarious conversation.
And I was like, yeah, there is.
Because I think I sold him your book right there.
You did sell a book, and you got him to agree I look like Jesus.
I got the Jesus conversation. I go, you got to check out his book. He's trying to sell me tax advantages, and I go, hey, I'm with the guy right now. Go check him out on Amazon. That was good.
So my last piece is tax arbitrage. I don't believe in spending $1 I wouldn't have spent to save 37 cents. If I'm going to spend $1 for a tax advantage, it better give me back more than $1. So I buy artwork in collections, and then after owning it for 3 years, I can donate it to museums. Because I buy them in collections, I get them at a deep discount, and I get a write-off the full appraised value after 3 years. Oh, wow. So I get back $2 for every dollar I spent on art. So that's a nice framework of tax.
That's the IRS.
Yep, that's the IRS. I. That's the I.
We just got to the I. Okay, and all this is they could DM you and get all this? Start the process.
Okay, so if they say average sucks, I'll give them the financial health assessment, and I'll give them the tax navigator.
I'm pushing. Okay,
yeah,
good.
They get both. Tax navigator, they literally can just go down a checklist. Okay. It's over 100 tax advantages, all down the fairway. Nothing that would get them in a place where they would be audited, and if accountant tells them they're likely to be audited, fire the accountant, because the only time you're going to be likely to be audited is if you're not reporting your income, if you have weird, like every line of your thing is even instead of like the actual number, you round up, round down. That's a trigger for the IRS. They're like, why is this all even? You know, why is this $1,400 and that's $2,200 on these line items? Schedule C, being a non-business owner, 400% higher chance of audit than if you're a corporation.
Interesting.
Right. So there are things that will create
corporation
audits.
Or LLC? You're like straight up.
LLC is fine.
LLC, okay.
S corp, C corp.
You mean anything that pays taxes like
anything that's sole proprietor that goes Schedule C has a 400% higher chance of audit.
So, business owner. Okay, got it. Makes sense.
So
what's more to look at?
That's the I. That's the I.
That's the I. Okay, what's I2?
Interest.
Okay.
3 R's for this: restructure your loans, renegotiate your interest rates, and reallocate your funds. I'll start with reallocation. If you are upset that you're paying 10% interest, but you have an account that's only earning 5%, pretty simple. Pay it off.
Yeah.
Really simple. But at the same time, I have a 2.75% mortgage, and I have money that's sitting there guaranteed at 5% right now. I'm not going to pay off my mortgage. Some might because it makes them feel better. I don't care. I'm totally comfortable with it, and I'm earning almost twice as much as what I'm paying. The second thing is renegotiation. I learned this because I was moving once, and I called to cancel some of my utilities, like even like cable back then. I'm like, well, what if we could get it to you for $100 instead of $170? They didn't know I was moving. I was like, okay, maybe. Still not worth it. Got them down to $70. Then I'm like, great, I'm moving. Can you just transfer it over? But I was like, I wonder what would happen if I did that with my credit card.
They totally are cool with that.
So I called the credit card. I go,
I've done that.
I'm looking to do a balance transfer or maybe just cancel this account. It's not very competitive. They move you to the retention department.
Yep.
And I negotiated a better interest rate.
And
you've taught me about credit card stuff before.
The thing with the credit cards I learned is that if you call them, they have 0 interest rates. You can even call them up and go, hey, look, I got something in the mail that said 0 interest. Can I still get that? And they don't know what they mailed out to whom. And they're like, well, where did you see it? I'm like, I don't remember exactly where I saw it. I'm not saying a lie, but at some point you saw something about zero
There's
interest.
so many things.
And I literally have gotten that. But this is the interesting thing. I know you're not giving tax advice, but educate yourself. If I have an Amex card, but it has a down to like 10% interest rate because I reduced it, if I'm using that for business expenses, that is tax deductible, correct?
Oh, yeah.
The interest.
For sure.
So slow to pay, 100% to write off. I know it's 37 cents on the dollar, whatever it is. But that is, if you're going to put the interest, put it in the corporate
better
card.
to pay off other cards before the business card.
The business card, yes. That's
Plus, the business card, if you happen to be late, let's say you had a bad cash flow, they're not going to ding your credit on a business card unless you default.
Yes.
Whereas if you pay late on a personal card, you have 30 days before they ding your credit. Right? So
problem.
The last R is just restructuring loans. I know people that have a paid off car and a 20% interest rate credit card, 19% or whatever.
Makes sense.
I'm like, refinance the car.
Yep.
Pay off the credit card.
Yep.
A car loan is an installment loan, and if you pay it on time, it will boost your credit.
100%.
A credit card, if maxed out, will lower your credit because they look at your utilization rate. So I've just seen people that they could restructure loans, refinance a home, get a home line of credit, and they can get much better interest rates, even make it potentially tax deductible.
So, okay. So somebody sits down, they say, all right, makes sense, Garrett, going to get the thing better with the IRS. Is this like, do all this stuff or do little pieces of it? Like, what would you recommend to somebody? I know you got classes, I know you got curriculum, and I really love the idea.
I just think you take your time with it and you find out what's the most momentum first, highest impact, lowest effort, and then what's the biggest momentum that does require effort. Get momentum. Money loves momentum. It just does.
Yep.
Create that momentum and then space this out. This isn't to be done all at once. You can't stifle every part of your life, but if you have no, corporation, I would start there.
Got it.
If you're a business owner with no corporation, get that done. You can have it done in 2 days. Then just prioritize.
Okay.
Yeah.
Interesting, because I figure a lot of this stuff, and I've luckily I've had people like you in my life, and I've learned this over the years and figured a lot of this stuff out.
You kind of have a mind for this. You think about this stuff a lot.
Think about it. My parents, were pretty documented on the things they did. They were W-2s their entire life. They saved. They did a lot of things you probably recommend not to do. You do it long enough, it's still going to work out. So there's nothing wrong with anything anyone's doing. There's a way to get where you want to go faster if your goal isn't money. So I want to backtrack before we go to the other two I's. If your goal is not make more money, your goal is to create cash flow, you're saying.
Yeah. So the first thing is financially fit. The second thing is financially independent.
Got it.
Financial independence is having enough cash flow from assets to cover your expenses.
Yep.
So just imagine, like, most people are taught, hey, save 10% of your income, chase a 10% rate of return in the stock market, wait for 30 years. My belief is, what if in 10 years you can be financially independent because you have assets creating cash flow? Then after that 10 years, every active dollar you earn can buy more assets because your expenses are covered from assets.
Yes.
You have a 10 times advantage. Then the third piece, the trifecta, is financial freedom. Financial freedom isn't what most people think it is. You can't have financial freedom by money in a bank account. It's a state of mind. It's a perspective.
Yeah, that's an interesting one. I play with that a lot. It's like it's that whole thing. I remember reading, I was Think You're Rich, or one of the books. Like, you turn on one day and you're like, where has this always been here? Like, is it like it comes out of nowhere? And I believe it is a mindset. I really believe it's that you believe you deserve it.
Yeah.
You believe
that's a big one.
I mean, that's a tough one. Not only religious deserve. I'm talking about like, it's okay.
You don't
identify as a struggler anymore.
Okay for me to
have
this.
money. Yeah. All right, I want to break in here real quick and remind you that motivation and mindset do not happen by accident. They happen by choice. They happen by decision. And why not start off the week in the most incredible way with an incredible Monday mindset that you can activate in less than 90 seconds? Go to michaelbernoff.com/Monday Mindset, and you'll get access to our quick 90-second emails and videos that we will send every single Monday to activate your mindset in business and personal and every aspect of your life, so you can guarantee to live an above average life. michaelbernoff.com/Monday Mindset. Get your access today. I talked to, do you know John Matson? He does, if you make 150 grand a year and you get ripped and shredded. Have you ever seen his ads?
Oh, yeah.
Of course, you get targeted by him because you make over 150 grand a year and you get ripped and shredded. And he said to me, he goes, the biggest thing he had is he had like guilt around having money. And then as soon as he eliminated that, he's like, well, that's bullshit. I got rid of it. The guy's making tens of millions of dollars a month sometimes.
Most people discount their value.
Yeah.
To people please, to be nice, because they feel unworthy or whatever it might be.
It's all BS.
That's the Money Unmasked book really addresses that aspect.
Got it. So it really gets you to realize like what you're actually doing psychologically.
Yep.
So it's psychology, it's money. They get that on Amazon. Where do we get that book?
GarrettGunderson.com.
Okay.
Yeah.
Forget Amazon.
Yeah.
GarrettGunderson.com.
They're doing fine.
They don't need you.
Yeah.
Yeah. They get it from you. Get a little bonuses through you too, which is good.
Yeah.
Yeah. They get it from you, which is great. So GarrettGunderson.com. Great book. Absolutely. Totally recommend. Appreciate my signed copy too.
Yeah.
Thank you. Okay. So what's I? I feel like a pirate.
Investments. Yeah. I. Investments is the next one.
Mr. Miyagi. Yeah.
There's a new Karate Kid coming out.
Is it really?
I saw the preview. Yeah.
Is it really? Mm-hmm. What's this one good? I don't know. Whatever.
Miyagi's not in it.
That's not a good movie.
But Danielson is.
Really?
Yeah.
Cobra Kai was good.
Yeah.
The first couple.
Yeah.
Nostalgic.
I watched the first season.
And then it got weird.
Yeah.
Anyways, third eye.
Investments.
Okay.
Remove hidden fees.
Before we get started, dude, what's your definition of an investment?
Well, that's a good question because most people have confused speculation and gambling with investing.
What's your definition?
The way that you create value.
Got it.
It's something that creates value.
Put money into something that makes more.
Yeah, for sure.
Okay.
Where most people are speculating to do that. That's not investment.
Okay.
See, I believe risk is in the investor, not the investment. Are you a risky investor or not?
Let's go deep on that.
Right.
Risk is in the investor, not the investment.
Like, is real estate a good or bad investment? Well, I guess it depends on you. For you, you've got events happen here all the time that help you create cash flow. There's other people that wouldn't have that ability. So this might not be a good investment for them. It's based upon your investor DNA, your values, your competencies, your drivers, and you get focused there and you invest in alignment with that. So some investments could be good for one person, but not another. Some people are good at business, others aren't. Some people are good at real estate, others aren't. Few people are good at the stock market, most aren't. So what happens is most people just kind of hand it over and hope for the best. But I feel like if you grow your money, but you don't grow yourself, that gap is called risk.
Yeah, that's a tough one. I've seen that, say, the biggest ceiling people put. So the Average Sucks book came out, is like the concept we get stuck at what we believe
that
we
thermometer.
Can do, thermometer, we get stuck at what we're worth. It is such a screwed up game, and we have an idea in our head of what we should be making, how our world works. I mean, that's a whole nother psychology and Money Unmasked, I know, that digs deep on the subject.
Well, most people kind of don't take responsibility with their finances. They hand the money over, hope for the best, and when it doesn't work out, they have someone else to blame.
Got it.
But there is no financial freedom without responsibility.
Got it. Which
So,
most people aren't good at. Money's energy.
Yeah, with investments, invest in what you know and protect the downside.
Okay.
Most people are not protected on their downside right
So how do we take care of this eye?
now. Look, you look at your expense ratios. Like, look, if someone's just going, I want to be a stock market investor, the S&P 500 index fund beats managed funds over 90% of the time over 20 years. So why would you pay the extra fees?
Even if you beat it by 1%, you're paying the fee anyways. Or 2%.
Yeah. Even worse, I see people paying a fiduciary 1% and paying expense ratios on a mutual fund at 2.5%. This is the impact. $100,000 at 10% over 30 years, if there's no taxes and fees, grows to $1.74 million. $100,000 at 9.2% grows to $1.4 million. $340,000 difference on less than 1%, because we're not looking at percentages. We're looking at the dollars and cents in the bottom line, but we're being taught to think in percentages because they seem inconsequential, but they're compounding. They're logarithmic.
So the same compound that you get, because I said all the time when the CD rate went to like 6.7%, I'm like, I thought that was amazing. I'm like, I could double my money every, 9 years or something like that. I thought it was amazing.
72,
I'm like,
60 to 72, right?
I pulled everything everywhere, and I'm like, what can I jam these into CDs? How long can I? What's the longest one I can get at that rate? I don't know if you played with that at all, but it was worth it for me.
Yeah.
And I jumped into those things because that was very high. It was no fees, nothing. Straight up, only fee was going to be my caps, cap gains. And I can figure out what to do with that later. But I look at these other things, and we don't realize how small these little inconsequential things, like in our businesses, little things we're paying for. Like I play this ridiculous game with myself where anytime I cancel something in my company, I immediately go to my bank and I transfer money from one account to another. So if I cancel a service,
So you actually capture that.
I capture the money.
Yep.
I don't do the NFL package. I had it for a period of time, $75 a year, or whatever it is, $75 a month for football season, $348 automatically. I've done that enough times. We're lazy as humans. I had about $30,000 to $50,000 a year going from cancel charges into an account. I've used
smart.
I've used it to buy real estate. We're lazy to cancel them all. Not one time. I had 25 a month that I was setting up of little transfers of $1, $5. People are lazy. Have you seen that technique?
I've seen it. I've never seen it that often because I'm in the wealth capture business. So I would teach that mindful cash management because there's a thing called Parkinson's law, originally studied in time. This guy, last name Parkinson's, was like, what happens if you give an employee something to do Friday by 5? You give it to them on Monday, guess when they start working on it?
Thursday.
Friday at 4.
Oh, Friday, yeah.
Yeah, it's like really bad. So he's like, I wonder how this works with money. So people that would get a raise if they didn't have a plan, that entire amount of expense would increase to meet or exceed it within 3 to 6 months.
Really?
So what you did was you said, it's there, I'm going to capture it, otherwise it's going away. Like, I don't think there's a lot of magic or mystical thing about money, but the thing that's closest is if you pay yourself first and you're intentional about these things. I call them being mindful cash management. Eliminate your destructive expenses, the things that don't lead to health or wealth for you, things that you're paying for but not utilizing, vices that you can't control. Lifestyle expenses, pay cash for them. Protective expenses, address them so that your money doesn't get confiscated with the next financial surprise. And productive expenses, increase them. Last week we did a 120% return on ad spend with what would the Rockefellers do. So what do we do this week? We up the spend.
Yep.
Now, if that goes down below 100%, we'll pull back the spend. But we're going to go as much money as long as it's still productive. There's no budget.
Got it. As long as it's getting return.
Right. But if it went down to 80%, there's a budget now. We're going, okay, we're going to move that back till we get to the numbers that we want. But most people budget the wrong things. What's my budget for marketing? I don't know. Effective marketing, unlimited. Ineffective, zero. And so I want people to think more in like productive nature and what can I do to grow rather than saving nature and what can I do to reduce.
So do you think they're trying to get somewhere or get away from something? And the reason I ask that, like investing, a lot of times I think people are looking for a home run. I've been there in Vegas before.
That's why there's so many scams.
Yeah, I've been there, and there's this natural tendency. I'm not going to get into people you and I both know that I see they create that same dream scam. There's some very basic scams. There's the dream scam that it could happen for you and that thing you have in your mind. You just haven't found the right person to help you get there yet. Scam. You know what I'm saying?
Yep.
Meaning that.
And it's like the make up for lost time.
That's what I'm getting
That's
at.
why they're willing to do it. They want to buy that story, and those people are good salespeople. They're probably not even involved in the actual mechanics of the investment.
The pitch.
They're just telling the pitch.
Yep.
So this is someone that you've never met that's actually managing the fund or whatever the investment is.
If there's a fund.
If there is.
Yeah.
It's unfortunate how often those are Ponzi's.
And it makes sense too, because the challenge, like all the bank debentures and stuff back in the day, and remember the bank debentures, and it gets 2% a day interest. One of the old adages of it.
Run those numbers, by the way. That's when someone's like, dude, I got someone that's making 30% a month on options trading. I'm like, run those numbers for 30 years and you're the GDP compounded. It's not possible to be sustainable. They might have done it 1 month, but here's the problem. Their emotions are going to come in when they fall behind because their identity became giving you 30%, and they're going to lose it all. They're not pros. You think that your buddy down the street is beating the pros? Why aren't the pros getting 30% a month? They're not. Buffett, 22% a year. That's the standard with someone that's worth that much money.
So what's he doing? So let's, because I just got invited. Joe invited me to go. One of the guys invited us to go to the Prospectus meet, whatever the meeting is, to go to
the one over in Omaha.
A couple months. I
guess at University of Nebraska.
I was going to check it out. Look kind of cool. Get on the floor and go meet all the guys. I was considering doing it.
Yeah. Warren's not a stock market investor. People think he is.
Go.
He just has enough money that he acquires public companies.
Got it.
And then he employs his methodology through those companies.
Got it.
So everyone's like, oh, look what he's done in the stocks. Well, he's not trading those stocks.
He owns the company.
Buying them. He owns the majority share at this point. Yeah, he has a minority share in Apple. He has a few stocks that he has, and his minority share is still pretty big.
Yep.
He's got influence over these companies he acquires publicly. And then there's the Buffett way.
He's not sitting with an E-Trade account.
Like my uncle was a VP for a company that Buffett bought. He decided to retire because what they wanted him to do was fire a bunch of people and ask other people to do twice the work for less pay. So it raised the stock value.
It's billions.
Because here's the deal. Here's another reason why I don't invest in stocks. There's a fiduciary responsibility to the shareholder, not to the employee, not to the customer. So what that means is there's a built-in conflict of interest to put the company's interest ahead of everyone else's. And that's fine if self-interest and Adam Smith, until it becomes short-term things to keep the stock market happy with the company. It pushes fraud. It pushes stress. I don't think it's a healthy economy.
Now, you not being involved is not going to make it go away.
Not at all.
Okay, but it's your choice.
It's just that I don't have to participate.
Okay, got it.
There's a lot of things you and I don't participate in.
Yeah.
That the world's going to continue to do forever.
Keep on doing. I'm not heading those parties.
But we're just not there. Yeah, we're done.
I used to know those places, but that's just not my thing anymore.
Yep, not our thing.
Yeah. Interesting. Okay, so you got I.
Yep. Last one is insurance.
Okay.
Insure the catastrophic, not the inconsequential. The first dollar we pay for insurance is the most expensive. The last dollar is the least expensive. An umbrella policy is a good example. It sits on top of your car and homeowner insurance. Yep. And it says, look, If you have multiple cars or even multiple homes, you now have one policy that says if it goes above 100,000, 300,000, 500,000, the umbrella policy kicks in. And with that umbrella policy, might only be $250 per million. So you've got way more bang for your buck. The likelihood of you using it is very small, but if you do, it's very catastrophic. So there's a high likelihood you make a small claim of $2,500. So if you're willing to move your homeowner's insurance to $2,500 deductible, you might be able to get millions of dollars of coverage because you're willing to take $2,500 of risk.
Interesting. So for me, I sold insurance years ago, like health insurance. And when the HMO PPO thing all broke up, I started getting into those health savings accounts. Are you familiar with HSA?
Yeah, I like HSA.
So I would take a $10,000 deductible because the guy said to me once, listen, could you borrow 10 grand if you got in a car accident? My mom would give it to me. My dad would give it to me. My sister would let me borrow it. I could take it off my bank. Why would I spend $2,000 a month for insurance when I could take a $10,000 deductible and get a $350 policy and cover the up to 5 to 10 million?
Yep.
And that's just health insurance.
When I was 19 years old and I bought health insurance, it was $10,000 deductible, $79 a month.
That's what I'm talking about.
I was like, this is amazing.
Amazing.
And now, what I pay per employee, based upon the new rules, as an employer, is so much higher than that.
It's crazy.
20x.
It's crazy.
20x.
I did come across a pretty cool company and a pretty cool product I'll talk to you about offline on.
Right.
But pretty cool that with the list where you can, because for years with the old administration, I had health insurance for everybody and then we had to get rid of it because of things that didn't work out the way they wanted them to with their plan. And then they got rid of everything and I was able to get it back again. But the list bill's been really cool. Do you ever done list bill? List bill actually allows you to get up to 2 to 3 people on, I'll have to get the guy and introduce you. But 2 to 3 people is all you need for the insurance. And it's a list bill. It's actually through the company and it could be per individual. It's brand new, just came out in January of this year.
All right. I love it.
Just a whole new concept. I'm bringing insurance.
Money, bro. I'm supposed to be the saving money guy. And you're saving money.
I went from $1,600 or $1,800 a month for my family down to like $1,000.
Yeah. Great.
Incredible. So four eyes.
Yep.
I love it. I want to ask another question I think would be important.
Yeah.
Do you think, this is big for our audience because we've got all kinds of people on here. Do you think, let's go deep right now on this question, it is a conspiracy, a thought, a calculated thing, a years of thinking a certain way? Is it a control thing? I want the real answer.
Okay.
Why do you think it is so challenging for people to truly change their thinking pattern around money? Like, do you think that there's a conspired effort to avoid teaching, or was that just, I want to go here.
Indoctrination.
But is that, okay, who's indoctrinating?
There's billions of dollars of marketing to get you to believe you aren't going to be good enough with money. You have to trust someone else. It's just every commercial.
So is it literally they meant to do that, or is it more like they believe that? Is Charles Schwab been indoctrinated? Are they even around Charles Schwab anymore?
Yeah, they're
okay. Is Charles Schwab or JP Morgan, are they been indoctrinated as a company to get you to believe that they believe that you should believe that you need them, and that's the indoctrination, or there's even a bigger plan than that?
I think if you go to the book The Ascent of Money and how money came about and how it's operated, if we're going to get into the conspiracy side, we go to...
It's less conspiracy and more like it should be easy. You should not waste money.
Yeah.
Yeah. You should spend money, invest money.
In 1913, we had the U.S. Revenue Act. At the same time, The Creature from Jekyll Island, if you read that book, talks about fractionalized banking came out. So fractionalized banking is saying we're going to lend $1 out more than once, which basically creates inflation. So what happens is we have money as a store of value, but it's losing its value day by day. And for a government, that's a much better thing than collecting that money. So if the government owns, they owe $36 trillion, that's hard to collect $36 trillion. But if they make that $36 trillion feel like it's only $18 trillion by just inflating that money down, that's a better situation for them. It's harder to collect the money. And if people are like, it's just inflation. Like, I still have $1 million. Yeah, but $1 million today is like $100,000 not that long ago.
Because we fall for it.
They sell it to us in, we're providing so many services.
No, not that part. The inflate, no, that part, but not cut off. Like, how do they
try to
get
tell
us to
you
just act like it's okay when it's not?
They try to make it like that it's too complicated for us. So here's a perfect example. They have made it so complicated that when the Federal Reserve decided to do quantitative easing, quantitative easing came out during COVID. because they said, look, we need to add money to the money supply, but the way we're going to do it is two main ways. We're going to give it to Wall Street, because then they're going to take all of the money and invest in infrastructure that's going to create jobs, and we're going to give it to banks because then they're going to lend it out. But you know what Wall Street did? They did stock buybacks. They didn't build infrastructure. And you know what the banks did? They sat on it because they were worried about the economy. This is why Silicon Valley Bank went under partially, is because they were sitting on so much cash, and then they raised interest rates, and that meant the value of that cash that was in bonds went down.
Wow.
And then people heard and started sharing, because the news travels fast on the internet, hey, they're in trouble. Then there was too much redemption at once, and it collapsed it.
Yeah.
Right? But it was all that extra liquidity that created a problem for them. And so the person that they put and appointed in charge of quantitative easing, I listened to him talk. He didn't understand what they were doing or why they were doing it. He was a patsy. Other people understood what was going on.
They put him out there and just told
him out there. And he's like, I watched the documentaries. I watched interviews with him. I'm like, he didn't understand. So now they mess it up so bad they go to quantitative tightening. So now we're going to take money off the table, which means people are spending money that doesn't actually exist. And then we start to see that roll back. It starts to hurt families. Inflation exists. They're barely able to make it because of everything that's going on. It's a mess. But you know, if you go back and read that book, I'd rather people read it than me tell them about it.
Which one?
Because the Ascent of Money.
Okay.
It's a brilliant book talking about when, you know, the thing that lasted the longest was the flora out of Florence, hundreds of years. But, you know, they just talked about country after country just inflating the money to death. And there's places like Zimbabwe where you have to be a multi-billionaire just to buy bread because they inflated the money at thousands of % to the point where it collapsed the entire financial system.
Wow.
And so there's so much going on, and it's so complicated because there's so many moving parts. So I think that the most intentional thing, though, is to have people be confused about it. And then there's things like, oh, let's have teachers teach. Really want teachers to teach about money? They're in a socialist system getting paid a salary. The only way to get a bigger salary isn't to be a better teacher. It's to get more degrees. And they're already burdened with how much they have to teach with kids that are disengaged and on their phone. And we're going to ask them to teach about money, which is a store of value, which is
Something
really a piece of energy. Yeah. And if they can't see it as energy and understand it, money follows value, not effort. That's why people are upset, is because money doesn't play the rules of effort and time. Money plays the rule of value, and that's all money gives a shit about. Is there value? I'll follow that value. So did someone serve? Did they solve problems? Did they add value? And these people that vilify billionaires, it's insane. That's like, they've created so much value and we hate them for it.
Look at Amazon. It's valuable.
How many people use it?
It's so useful.
I use it all the time.
Okay. And honestly, to think about it in a grand scheme of things, I don't think they charge enough. Think of the infrastructure they put together for what they did. For us to create that would be impossible.
We couldn't drive to the store to get some stupid thing.
Instacart? Are you kidding me?
One click.
Yeah, I've been to a grocery store. I mean, I'm paying a fortune for it, but it's worth every penny if you understand the value. This is where I first, when I was about 19 years old, I met Jim Rohn. Jim was my mentor.
Nice.
And Jim took me under his wing, and he taught me about how, I listened to his audios first, and then I met him, and he talked about how your life, your economics are based on your value to the marketplace. How much money you bring to the marketplace. Like how much money, I didn't understand exactly what he meant, but I get it now. Like if you solve a problem of another person, that is valuable. If you do not create value, eventually you'll be eliminated. And that's the thing with AI. We can get into that conversation.
AI can either make you more valuable or obsolete. It's your choice.
So let's talk about something interesting with AI. You shared with me earlier. A lot of what you taught for years, AI is able to serve now, you said, correct?
Mm-hmm.
Okay, and how does that feel?
Great, because it means all the busy work that's the least interesting, least impactful things are now being removed, so that I can actually get to the place where I'm more intimate with someone to find out what their money blocks are and to get the conversations around legacy.
And AI does that.
Well, AI can just remove the other busyness of like accounting, and they can help me get report of findings quicker, so my guys can actually have longer conversations about what's important versus spending all this time in the details that are exhausting and transactional and boring. So, I mean, it's still got a ways to go, but it's happening fast.
Yeah, it's interesting because you mentioned to me earlier about like some of the stuff you used to do got eaten up by AI. Mm-hmm. And I think about that. People are like, oh my God, I'm losing something. I'm losing value. You're actually getting more value because you're able to do the thing you do better, or you're able to hit more people. So actually, instead of thinking you're losing something, because I remember when I'm
gaining time.
When I first started, when I went from selling my tapes and CDs, because I've been doing this so long, I had tapes and I had CDs. That's how long I've been doing this.
Me too. I had those Nightingale Conant big boxes.
I had them and I had my own. I made them. And with the clamshell thing, and you'd open it up. I got mine off the Bangadir Highway in Utah. There was is it Bangadir? Did I say that right? Bangadir Highway. There was a plant that did the moldings for I'd fly up there and I'd get my like clamshell things to put my tapes in. I remember when I first realized I can't sell these anymore. I got to give them away online. First, I was like, dude, I'm not going to make my $99. Then I realized how valuable it was that I could share with a bigger market. A company called YouTube created value for me. I lose my initial value of my $99, but I can now reach 50
so many
million
more people, more efficiently, more effectively.
That's money.
And I mean, the people I'm seeing using AI the most effective, they're just becoming more valuable because AI is helping them solve time equations of the work that they hated.
Yep.
And it's pretty amazing. Like what my creative director's starting to do with AI to create South Park cartoons about finance that are hilarious. It's like, dude, that would have taken illustrators and so much time, and like we could have more fun. He's written, he'll send me songs all the time about my books that are hilarious. Yeah.
So how does that, back to the question of money here. So you got a husband or wife listening to this right now. They're on board. Let's have the tough conversation. Their wife or husband's old school. They're trained by the old system. You've just converted someone in the last 44 minutes of the show. They're like, oh my God, Garrett, you're legend. I'm going to download it. Again. We'll put it on the screen. We'll put how they get a hold of you. They send Average Sucks to Garrett B. Gunderson.
Garrett B. Gunderson on Instagram.
On Instagram. And they send it. They do the financial thing. He's off to the side. Didn't want to tell his wife, or she doesn't want to tell him. She lowered the rate with the credit card. They get extra money now, all this stuff. But they're old school, the person. How do we convert the wife or the husband to join if one is, I don't want to say old school. Let's call it highly indoctrinated by a system that isn't exactly working.
So they got to take the money persona quiz, which comes with Money Unmasked. That's going to give them a sense of like what the shadow persona is, so they are aware of it. But then it shows them how to get to a winning persona where there's collaboration. And so that's the first piece. The second is when we're finding money that's being lost, they stop worrying about it. And they might be loving their old mutual fund. Great, keep it. We're going to just be more efficient and help you build more wealth. We don't have to replace it. So if someone's like really in love with paying off a mortgage, I'm going to be like, great, let's get there the fastest way.
Okay.
I'm not going to talk them out of that. If that's what their life's goal is, I'm not going to be like, well, it's inefficient, because personal finance should be personal. So the best thing they could do is get on a deep dive call with my team, go through everything as a couple, and then get the report of findings, and then they can select on the report of findings. Yeah, we want to save tax this way. No, we don't. Oh, this would help us protect our downside. This I want to keep the way. Like, they can make the choice. We'll give them the whole thing, and it's still their money, not ours. But we're here to give them a different perspective.
So how'd you get into this? So you banker family, dad's a
coal miner.
Yeah, coal miner.
My dad's a coal miner. My grandfathers were coal miners.
Really?
Yeah, great grandfather's a coal miner. Yeah, Price, Utah.
Coal up there? Okay.
Yeah, Carbon County,
so
Utah.
So your father's a coal miner.
Yep. Retired now, but yeah.
Your father's a coal miner with a coal miner union. Severance and all that stuff, whatever you get from them. Yeah. You're probably pretty good income, did his thing,
I mean, in the early days it didn't quite keep up.
Yep. Well, the trains and everything, things changed.
Things got more efficient.
So what makes you decide to do this?
So I won $5,000 being the Young Entrepreneur of the Year when I was a teenager.
What was your business?
Car detailing.
Okay. Do you know local little Nick Brown, this little kid here locally here?
That's
another guy. Man, he owns dude, this guy sells to the ultra wealthy. He does all the cars for everybody we know. Tommy Mello, he does my car, he does everyone we know. He's up in Silverleaf, Paradise Valley, doing Joe's cars. He's like this young kid, and then you get the $150 to get your car washed. It's amazing, but he does a great job. Young kid, loves supporting him.
Yeah, that's
what you did?
When I was 16, I would like drive to an office, get their car, bring it back by lunch or by the end of the day. And I ended up with employees, and I ended up presenting, and I got this $5,000. I'm like, I want to invest this money, but I was under 18, so you have to have a custodian. My mom was like, I'm not going to sign off on that. So when I was finally 18, I make a mistake with my first investment. They sell me this crappy product, but fortunately it was only $240 that I lost. And I was like, all right, I got to figure this out. And then I got offered an internship by a financial firm because I'm asking all these questions. Someone's like, you should talk to my dad. He's like, we'll offer you an internship. We'll pay you $2,000 a month. You can learn about finance and bring you your family and friends, and we'll peddle them some products. But it was the start.
Interesting. Okay, and that started investing. And then
I could remember things about finance. Like I could read about the way a 401k worked, and I could basically recite everything in that document to you. But I could read about technology and not know what the hell I just read.
So it didn't drive you technology.
So it just made me. I just understood finance.
Okay.
Quickly.
And then how did you go to start educating people?
in the year 2000, the market starts to decline. I'd been financial advisor for 2 years. And all of a sudden,
Were
it's
you
like...
the big bank or?
I was with Park Avenue Securities and Guardian, mainly an insurance company, but they had a mutual fund division. Not the best, but fine. So, I mean, they're gonna, some Guardian people are gonna hear this and be pissed off.
Whatever.
Whatever. So anyway, I'm feeling good in 98, 99. I'm a little financial Einstein in my little community, but it's all like my parents, my grandparents, the parents of my friends.
People
and then
church.
The market goes down. Well, these guys were all in like double E bonds and savings accounts, and so like, what's going on? And I didn't want to tell them.
You got them out of double E?
Yeah.
Okay.
So I was like, oh,
Those
yeah,
are the safest things in the world.
Put your money in the market. It's been doing nothing but 10, 20% through the 90s. Starts going down in 2000, a couple months in a row. So I talked to this guy that managed $5 billion in municipal bond funds, and I was taking his class, and he's like, hey, look, man, just tell me you don't know what you're doing. You're going to figure it out. He was mentoring me. So we moved him to cash. One of my clients left me. Everyone else stayed. 2001, 2002, we did 41 and 44% positive return when the market was down double digit. And then I started to travel around. Every single month I'd go meet with someone because I was young and learn from them. And I learned big money was saving tax. That's what the biggest, wealthiest people are doing first, was saving tax. They're protecting their downside. I just started asking a ton of questions. I had a red memo pad. I'd fly to New York. I'd fly wherever. I would go to meet with, because I was doing some insurance. I met with actuaries. I met with product designers. I was just curious because I didn't know how it worked, and I wanted to figure it out. And I didn't want to tell my family or my clients, "Oh, you're in it for the long haul." That's a dumb thing. Oh, the market's on sale. Would have been nice to know before it went on sale, before you put your money in, right? So that's how it all happened.
Interesting. And then you started training people, and then just one thing turned into another?
Started training financial advisors, actually, because I wanted to become a better speaker. And I was doing big numbers as a young kid. And everybody's like, how are you doing this? So I had 3 partners. We started a study group on Fridays. People would hear about it. They're like, can we join? So by the end, we had 180 people in the study group that we were doing. I was leading it, and then my 2 partners died in a plane crash, so it kind of killed the study group. But we were just young kids that they're going, how are you doing this? We just weren't so attached to the old ideas. I was like, our number one philosophy was, we are concerned with what's right, not who's right. So if we're wrong, we're going to admit it. And we're going to debate people. I was debating accountants. I was debating other investment advisors. I was pretty good at it. Arrogant enough to think I could win all those.
You were young, and you were figuring out as you went along. You had nothing to lose.
But at the same time, I was willing to admit if I was wrong.
Interesting. That's really, I didn't know that story. Have you shared that much?
A little bit. And I mean, I made
important for people to understand.
I made some early mistakes in my 20s because I thought, oh, dude, I'm gonna buy a bunch of real estate. I'm gonna start a hard money lending fund. I'm gonna do IPOs. I'm gonna do oil and gas. And what I learned was I had a bunch of distractions. I wasn't amazing at any of those things. And that's why I was like, no, my real estate are books. That's why I wrote 10 books. That's a piece of real estate for me. My value is going to be in my business. I want to be an educator. I want to be the most impactful financial entrepreneur educator on the planet. That's what I'm here for.
So how do you do this? So how do you think of this? So there's a million people out there covering a million different things. A lot of them are friends, and I think every one of those avenues is good. How does somebody, or how do you not get pulled into this guy's thing or that guy's thing? Because I've done it before. I'm going to try this guy's marketing thing. I'm going to try this person's thing, this lady's thing, this thing. I'm going to go this. We're going to do real estate this week. I'm going to get chemicals. I'm going to do gas. I'm going to get art. How does somebody, what you're sharing is, get your shit straight.
I'd be worth hundreds of millions of dollars more if I didn't get distracted in my 20s.
Okay.
Because I look at it, every dollar that I'm going to allocate requires stewardship. I invested in a mutual friend's company a year ago. I haven't heard crap about it, and that was my last time. I'm like, why am I investing in someone's company? I have my own company.
Yeah.
My vision's big enough. I'll just invest in people, processes, and procedures to automate and create technology.
I think it might be the one. And you go home at night, it might be the one. It might be easy. That free money that'll lure.
I hate even getting a document I have to sign. I'm like, this is time I could have been writing. And instead I'm reading a contract, which isn't fun. So I just say no to all of it now. So
you think everybody here should really invest in their business?
Yeah.
Invest in their money.
And then find a way to transition your business wealth to personal wealth without risk.
Got it.
Or as risk mitigated as possible.
Personal to business or business to personal?
Business to personal.
But at first it may be
grow the business.
Business to business.
Just grow
business
the business.
To more business to business to personal.
Yeah, totally.
To business.
But it's just
and run it through the business.
But don't justify overspending in a business because the cash is there. Businesses have insatiable appetites.
Yep.
And so if you don't find a way to eventually transition that to have captured for you, for your family stability, and for cash flow that doesn't require your daily involvement, that's where the transition happens.
I think that's
But don't suffocate the business early on to try to fund a retirement plan.
Got it. Okay. Interesting. Covered a lot of things here today. This is really...
It's because you're a good interviewer,
This
dude.
is really good.
You got me to share, I mean, we talked about the stock market issues that I don't really talk about ever.
Yeah. Well, I thought about the thing with the Warren Buffett thing because a lot of people look at that. The fact that I believe 95% of what we see out there isn't exactly what we see. Like, it's not like Warren Buffett is not trading stocks. He's just not doing our perception of it. So I think our perception of what we think people are doing versus what's really going on, because every wealthy person I know, they do a minimum of what it is you're talking about. They're not overpaying in certain areas. They've mitigated taxes. Like I even saw this. Did you know about home deconstruction? Do you know about that write-off?
Like tearing a house down.
And you could donate it? Do you know this shit? Okay. So did a...
like the conservation easement?
Bought a property. I had no idea it was about the demo of the property. I had no idea that you can write off each of those pieces, all the construction, all the pool, all everything, not a tax credit, but a write-off up to, it could be anywhere between $100,000 to $1 million. A completely IRS code, I had no idea. So when you knock over a house, most people put it in a dumpster. You can get a write-off up to the next 6 years, up to a certain percent of your income. I had no idea this existed.
See,
so 90, but
twice now.
Twice.
Today. Look at this.
But think about this: 95% of the builders out there aren't educating themselves. So if we could actually learn what you're teaching, be a gym owner. Don't educate people, but not advise them how they could build a plan in their company to write off their, let's say someone's a gym owner, get really good at sales, convince an entire company to learn the tax strategy to offer everybody the ability to do this, write that off. I have no idea how that works. It just educate yourself. We could help other people with this, what you're teaching, make the world better. And really, this is really exciting.
Yeah.
Yeah, I know you're after that, but that's my thinking. So, anything else? Any other advice you'd give, or anything else that you're feeling these days? It's that Garrett's working on. Garrett's excited. You got the comedy thing going. You got
on Amazon Prime now.
Amazon Prime.
The American Ream on Amazon Prime.
That's good, right?
Money comedy. I wasn't gonna be the funniest comedian, but I'm the funniest money comedian.
Yeah. I never heard of such a thing.
Yeah,
it's not funny to not have money.
I'm a one. I'm the one of one, so that's why I'm
I've seen the episode. It's fantastic.
Thanks, man.
I've seen you live, and I've seen the episode, and that's about a big thinking. Last thing I'll bring up is you and I talked about bigger thinking and everything. What is your strategy for thinking bigger? Because there's two things that I realize entrepreneurs do. One is I know you do well. This took one conversation. You wound up here in the studio, which is a very decisive person. Yet, what is your strategy for thinking bigger? A lot of our friends talk about this. I was talking to Jeff Hayes about this once. He goes, "Can you just call me every couple months and just tell me, think bigger, motherfucker?" And
I just saw him on Monday. Yeah.
He talks to me. He calls me, "Will you just tell me to think bigger?" What is your strategy for thinking bigger?
So I go back to when I did Killing Sacred Cows, and I came home to my wife and I said, "I'm going to make this a New York Times bestseller." She goes, "Of course you are." And I was like, "Well, I didn't know how." So I was like, "Well, what do you mean, of course?" She's like, "Yeah." And then I hit New York Times and I was like, oh, that was small thinking. So I have to tell my wife something and have her be like, how in the hell would you do that? I need her to be like, how would you, like, I need her to think that's so crazy and big that you'd have to explain to me the possibilities.
So what's the difference between radically, outlandishly, stupidly, make-believe, fantasy, Mr. Rogers, dumb, not real?
Time.
And I get that, but if you would have said, to your wife, I'm going to the moon.
Yeah, well, I'm not gonna be able to prove that out.
Okay.
She's gonna
what would you have said about the book that you could have said?
I'm gonna make this the most impactful financial book of all time.
Okay.
So like what would the Rockefellers do? Is getting there. It's got a ways to go. But it's got 2,500 organic reviews, 2,000 5-star. We sold hundreds of thousands of copies. I'm about to license it to one of the biggest insurance companies on the planet, which is gonna put 100 licensees, each printing out 500 books that they'll try to give out in 6 months. I mean, it changes my entire perspective, but it's not so crazy to be like, like if you're making a vision of status, there's only so much status out there. There's only so much attention. But if you're making a vision of impact that's not a zero-sum game, but a positive game, I think it's possible. And I think that we get really resourceful if we are committed to it, but if we don't believe it at all, we're never going to get resourceful. So I just have to create a big enough vision that I'm willing to take as many no's as I have to get to yes. It's like when my son had auditory processing and they're like, hey, he's going to have these issues the rest of his life. I turn to my wife, I'm like, you're a researcher. I'm an earner. I'll pay whatever it takes. We'll take it wherever we need to go. Let's start going. Let's figure it out. She found this thing, Brain Camp. She's like, it's going to be like $250,000. I'm like, we're going. And he's like, he's a normal kid. He got through it. So you just get resourceful. And if it's like so intimidating, I wouldn't be resourceful. That's when I've thought absurdness instead of reality. But I do like that. I recently had to talk to a mentor and say, am I delusional with this new vision? I'm like, it feels like maybe I'm delusional. He's like, you just have the wrong time frame.
Got it. So you're thinking it's happened quicker. So it's all time frame.
Yeah, I'm always like,
you can get wherever you're going to get if you have enough time. If there's legitimately enough time.
Look, man, Nick Halleck, I wrote a book with him, 5-Day Weekend. And he says he had 10 major goals. Be in a rock band, did it. They, made good money. He was like, they're big goals. They're like, one of them was go to the moon. That's only, but he actually paid $20 million to the Russian government to go through the cosmonaut training and then almost got it, but someone spent more.
We're all laughing. We're laughing. It all sounds crazy. Right?
Yeah. It's like, hey, he's willing to put serious money and figure it out. And will he get there? I mean, maybe.
Okay. So if you give it enough time, it works.
Yeah. I mean, who knows, man? Maybe with where we're headed, maybe 30 years from now, that isn't a big deal. Maybe it's just a big deal right now.
It sounds like a big deal now, but then a lot of things did. I mean, if you think about just anything, I remember being at the mall when I was a kid. My buddy Joe Burdick, he good friends. He actually came to one of my events later on. Have you ever had a high school friend come to your events?
My comedy stuff, which has been super cool.
Crazy cool. So Joe, we were in the mall when we were kids, and Joe's like, wouldn't it be cool if there was like a way that you could go in a store and they knew exactly what you wanted, and they could have it ready for you, and they just like read your mind? Dude, it's called Amazon. It's called I mean, eventually that's going to be a physical store.
Totally.
We're going to walk in, and it's like, so it just didn't give enough time. So that was 1992. By 2012, that was happening.
Yeah.
That's not a lot of time.
Right.
Less than 20 years. And now it's even happening quicker. Yeah. So that means people with their money, if they get this plan together with all the possibilities of what goes on, what used to take a fortune and time to create wealth, because I always tell everybody I'd say the worst addictions in the world, and this is where I catch a lot of heat saying this, is drug addictions, drinking. If you can get over drugs and drinking, you get your life back. Gambling addiction, you lose all your wealth in one day. You don't get that back very quickly. And that is a different animal. I'm not saying one is worse than the other. I've lost friends to both. But I will tell you, if you gamble the entire family's inheritance away and it took you 40 years to get, you can't just go get that back tomorrow. It's going to take a little time. Right. But with what you're saying, with how fast time moves, you might get it back in 2-3 years if you play the game correctly. Yeah. Cut back on loss, increase the ability to invest.
Because what you have is mental capital and relationship capital.
Yep.
So if you learn your
lesson.
Yeah, if you learn your lesson, you develop mental capital. If you don't, you make the same mistake.
Yeah.
Relationship capital, you can just, if you're willing to ask for support, a lot of people just won't.
Yep.
That's why they're slow.
Yep. Yeah.
They try to do it all alone.
Yeah. Doesn't make any sense.
They think it's weakness. It's called collaboration.
So you think they should try to figure out their money game themselves, doing the same thing they're already doing? Do you think they should download that thing from you?
Right. I think maybe borrow some of my knowledge.
Yeah, I'd love to share. So I definitely have known you now for a decade?
Yeah.
I think we met originally, was it through JJ?
It was.
You thought I was the credit card guy.
Yeah, she goes, hey, you need to talk to Michael.
Guy, the credit card guy.
And you're like, get this card. I just paid for a hotel last night with one of those cards, by the way.
Crazy.
Like with the points.
Isn't that nuts? Yeah. Do you know, if you do it right with like some of these things like the Citibank double cash back, get 2% back, you actually, and the people spend enough
I literally just hired a firm just to handle it for me now.
It's freaking nuts.
With
you
all the
could take
arbitrage.
that money and you could buy real estate with that thing.
Yeah.
You can actually use that in those little funny checks you get from the credit card with 4%.
Yeah, they had me get American Express Gold for some reason.
Instead of the Platinum.
And then I've got the Chase Sapphire and all that. Yeah.
You can literally, I got to give people access to this thing. If you take those silly little checks you get from the credit card company that'll give you like $50,000 at 4% once, not 4% a year, 4% once.
That's a sweet deal.
You could literally be smart. A lot of people miss it. They invest, they gamble those. But if you can get that check and pay 4% once for $50,000, there's enough things out there in the market you could get 10 or 20% and put that in your business right. That's a whole nother story. I'm not giving advice. I'm just educating. That's my safety net right there. So anything else anybody needs to know? Where do they begin? So find you online. We'll
Garrett
post that
Gunderson, DM me.
DM you. You'll chat.
Follow me.
You and
Watch
your team. We'll
the
get with
Daily
them.
Doses of Finance. There.
Which book do they start with?
Money Unmasked, for sure. Yeah.
Go to GarrettGunderson.com. Get the book.
Yeah.
So, brother, appreciate you. We're going to do this again. That's super fun. Love it.
Thanks for having me, man.
I'm excited to have. We'll do this again in very, very near future.
All right. I'm in.
All right. Game on. All right, listen, let me take this opportunity right now to congratulate you for living a life that screams average sucks. How do I know that? You're listening to this right now, and I can guarantee you're a person that wants more in life. So 1, congratulations, and 2, I bet you're looking for a shortcut. How do I get there quicker? How do I make this stick more? And since 2008, the fastest way that we've showed people how to become a person that lives a life that screams average sucks, and on top of that, become a person of influence and get what they want in this world, is our Core Live event. We've got one coming up very soon. The website is simple, michaelbernoff.com/Core Live. All the information, all the videos, and everything is there to find out more. And also an incredible early bird special to give you a big old discount. Again, michaelbernoff.com/Core Live, and I'm excited to see you there.